When we look at the valuations of companies in the S&P 500, they are starting to get a little bit more expensive than perhaps we would like to consider, and that's no surprises given the strong performance we have seen in just the last 30 days. Many companies are working towards being up double digit in just this period, and then again this is reflective in investor sentiment as we are now sitting firmly in greed, a score of 61, and for those that have been following the channel, you'll remember just last month we were sitting low single digit at 3, so quite a turnaround we have noted, and you can argue a lot of this has been with the Trump tariffs that have been put in place going back to Liberation Day, where we saw some very high, astronomical figures in fact, of tariffs being put in place. If you remember, 145% on Chinese goods, but we are now hearing that Donald Trump is perhaps looking to reduce this at around 80%, but these are continually changing, and that is why our focus in today's episode is on 4 quality stocks that we do quite like, and we're going to discuss each one in terms of an entry price and where we see this company over the longer term. Starting off with number 1, Uber doesn't need any introduction, up 22% over the last year. Year to date, up nearly 38%, massive outperformance of the S&P, which has actually struggled just over the last few months, and over the last 5 years they have outperformed up 153, although we do notice they are making movements towards their 52-week high of $87, with a strong buy from Quant, a double buy from both Seeking Alpha and Wall Street, and just in their latest quarter we did get a fairly strong performance. Revenue was up 14% from the same quarter last year, and we noticed efficiencies to both their gross profit up 1 percentage point, but their operating profit was up 9, looking very strong, whilst also seeing an increase in fact on their gross bookings, as well as their monthly active users and the trips that were performed. So overall, step in the right direction again for the company, which has been performing very well over the last few years. However, over the next 4 quarters, they do anticipate only one of them to be growth, but they have a 100% historical track record. They've outperformed every single quarter against analyst targets, and for those that want to see their valuation based on the next full accounting period, EPS estimate $3.39. This in turn gives them a forward P on 2026 numbers at 24.3. Now there's a lot to love about this company, so we will just reflect on a few points that we want to draw to your attention. Their free cash flow has continued to increase over the last few quarters, going from negative in fact all the way back in 2019. We see them transition into positive free cash flow in the middle of 2022. And actually speaking on a valuation perspective, incorporating the free cash flow, so Uber's price to free cash flow in fact has been decreasing over the last year or so, and now we are noticing it towards one of the lowest, if not in fact the lowest it has been, and that is what we would typically consider as a potential undervaluation signal. And as we mentioned earlier, gross bookings looking very strong. Whilst we do notice a dip in just the recent quarter, we can see that consistent growth of 17.8% year on year going back to 2019, and the free cash flow margin looking very strong. Again, we do see it go from negative to positive in the middle of 2022, sitting at 3%. In fact, now we do note in the end of 2024 at 16%. This is very strong, but what we love about this is the consistent growth we are seeing on a quarter by quarter basis. And also worth reflecting on their Uber Eats division. This is one that has in fact been increasing at 55% every single year since 2019, and they're also outperforming pretty consistently against DoorDash. Some would argue they are one of their closest competitors, but we can see whilst DoorDash have been increasing at a slightly faster rate, in terms of total revenue, Uber definitely takes the cake. And EBITDA, again, following a very similar trend from what we have seen on other metrics, moving from negative to positive and only going up in one way, and that is the right way we do want to see as investors. And finally, we'll also point out that if you want to compare Uber against Lyft in terms of the monthly active users, not only is Uber significantly above, but you could argue the disparity between the two numbers does mean that Uber could effectively be seen as a monopoly in the market, and we also want to point out that Lyft does have very minimal growth on a quarter-by-quarter basis, unlike what we can determine from Uber. Now, going back to the valuation that we did see, remember, very low in terms of price to free cash flow. Overall, though, they do get a D+, and this will depend on which valuation metric you want to look at, but the main thing to take away here is for the vast majority, including on a forward valuation, Uber is trading at a premium. For example, on this valuation, a 25% premium, but as we can see, pretty much for the large majority, this company is trading above the sector. Two questions we always have to consider. One, do they deserve a premium? And two, how much of a premium is warranted? Both of these we will cover in the episode. But we also believe it does add some value to consider what the institutions themselves are doing, whilst never relying on them for our buying or selling decisions. They hold around 80% ownership. We noted, in fact, 13 billion worth of selling over the last year, but a lot more buying, nearly twice as much at 20 billion. And also worth highlighting that in the most recent quarter, Q1 FY25, they bought 1.94 billion versus 1.3 billion selling, so very clear and obvious, institutions clearly bullish on the company. Now, they also get an A on the growth, which is great to see. Remember, we did say they trade at a premium. Do they deserve it? It is looking likely. Year-on-year revenue growth 18%, forward-looking 16%, well above the sector comparative at 3 to 5%. But we should point out, over the last 5 years, they have been growing their revenue at a faster rate, 34 and 27%. Yet we do also like that it is anticipated for their EPS to grow 28% over the next 3 to 5 years, well above the sector at 11.2. Finally, we'll also reflect on their profitability. That does come in at an A+. Gross profit margin 34%, above the sector at 32%, in line with their own 5-year. And when we get to the bottom line, net income 27%, well above the sector at 6%, well above their own 5-year where they were burning through cash, negative 19%. As highlighted, in fact, when we did look at their historicals, they were negative for a vast majority of that time. But cash from operations, maybe one of the things to highlight, 8.1 billion, well above what they've been generating over the last 5 years, 674 million, but also well above the sector, 347 million. So clearly they do deserve that premium, and we're going to run through how much of a premium we do believe they deserve. Before we do though, as a quick recap, strong buy from Quant, double buy from Seeking Alpha and Wall Street, D+ on valuation, but an A on growth and an A+ on profitability. Now, intrinsic price for the company comes to $104, derived from the DCF model. Now, we have the free cash flow year on year, including 2024, where there was an increase of 105% from the previous year, 90% in fact on average over the period, and we've gone for 10% moving forwards. As you can see, low, medium and high, 8, 10, 12 respectively, and worth noting these numbers are subjective, so you can always grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether for Uber or any others, but based on the growth rate and the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see, 104. Now, we'll also show you, for full transparency, for those that believe 8% to be the more appropriate rate, $90, upside of 9%, and for those that are a lot more bullish at 12%, which you could argue does look to be reasonable given their past performance, at least over the last few years, $121, 46% upside. Now, we do typically use the medium rate on the channel, where we're not done there because we always like to add a margin of safety. 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that in today's episode, we'll buy at $94, then we keep going till it's near the current trading price, and we're effectively saying for Uber, very strong company, even in this brief deep dive, 20% MOS, with Wall Street themselves seeing this bang on $100 over the next year, upside of 20%. Now, we do like this company, and it has in fact been increasing quite significantly just over the last few weeks, but if we do want to add this, we would like a larger MOS. At 25%, a buy at $78, at 30 around $73, and you could argue right now 35%, $68 may be one to add. For us though, around the 30% MOS at the $73 mark we do believe does give a sufficient margin of safety for the company, and the upside also looks fairly healthy, but as always, not something we use for our buying or selling decisions, just one added layer as part of the process. Just before we move to the next stock, we want to let you know we have released our latest free weekly article. We drop one every single Monday morning to your inbox completely for free, where we cover severely undervalued stocks as well as what's going on in the market over the last few days. So click below, you can sign up and read straight away, where you'll also be able to grab a spreadsheet for severely undervalued stocks for the month, lots of information for each one, the upside that Wall Street themselves see over the next year, and you can also grab a recently released copy of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. The next stock we're covering is in the semiconductor space, the large mode ASML holding. Now, over the last year, they're down 23%. Year to date, they are up, although marginally at 2%. And over the last 10 years, they have outperformed the S&P, up 537%, trading towards the lower end of the 52-week range, a massive pullback from their 52-week high at $1,110, with a double buy from both Seeking Alpha as well as Wall Street. And just in their latest earnings, we did see some massive growth to their top line, which was up 46% from the same quarter last year, as well as efficiencies, 3 percentage points on gross profit, 9 on the operating side, as well as 7 on their bottom line net income. Also worth noting, their net bookings did look fairly healthy, and whilst you may not see it on a continual increase, it is important to understand that the semiconductor space as a whole is fairly cyclical, so we will never really see that rhythm of continual increases on a quarter by quarter, year on year basis. But the main takeaway from this is that ASML typically has a very large back order, and this is something that has been in line with analyst estimations, although some quarters we do get some variance. It is also worth highlighting that they do sell some of their products to areas where there has been geopolitical tension. That includes both China as well as Taiwan, and therefore this is why for this company it is important to incorporate a fairly sufficient margin of safety depending on your overall longer term thesis. And in terms of the next 4 quarters, they do anticipate 3 of them to be growth, as well as a 100% historical track record, trading on December 26 numbers at a valuation on a forward-looking basis of 23.1. Now, in terms of their current forward P at 26.7, it is significantly below their 5-year rolling of 34. In fact, one of the lowest over the last 5 years. That is one severe undervaluation signal, whilst offering a yield that isn't too dissimilar from their 5-year average at 0.84. And if we were to take a look at this valuation model, which in fact the blue tunnel does signal the expected fair price, we see disparity between even the bottom end and the current level, something that we have noted pretty much from around February, as well as some parts over the last year. This in turn does mean another possible severe undervaluation, something, as we say, we don't look in isolation, but will use it as part of our overall analysis. Yet we do see another poor valuation similar to Uber, where they get a D-. That again is because the sector does trade fairly lower, 30% premium on ASML's head, but in terms of the 5-year average, we do see them trading around 32% lower. Another consistent theme, no matter what valuation metric you look at, ASML at a discount to their own 5-year, but actually at a premium to the overall sector. Now, institutional ownership sits at 26%, with around 11 billion worth of selling over the last year, pretty much the same amount of buying. So at least over the last 12 months, institutions neither bearish or bullish. However, what we would say in 2025 in quarter 1, they did buy a significant amount more than they did in fact sell, so at least in the most recent period, institutions are becoming a lot more bullish. Growth does come in at a C+. Now, revenue year on year 18%, quite a large drop over the next 12 months to 10%, but remember, cyclical industry, so nothing to be surprised about, and it is still above the sector comparative in the mid-single digit, but over the last 5 years, they have been growing their revenue at a faster rate, 20 and 16% respectively, yet they do anticipate EPS to grow at 19% over the next 3 to 5, above the sector at 14, but slightly below their historicals at 22.4. And finally, profitability at an A+, gross margin 52%, slightly above the sector at 50 and their own 5-year average, Bottom line, 28%, above the sector quite significantly at 4 and slightly above their 5-year at 27, whilst generating 12.3 billion of cash from operations, a lot higher than their 5-year at 7.84 and significantly above the 110 million from the sector median. Now, recap on this company with a double buy from Seeking Alpha and Wall Street, a hold from Quant, D- on valuations, C+ on growth, and an A+ on profitability. Now, intrinsic price is still around the $1,000 level, and when we take a look, we have used a growth rate still at that 14%. Just in the most recent year, it was up triple digit, on average at 41%. Now, at this growth rate, it does come to upside of 49%, but again, just for transparency, at the 12%, $920, 30%, and for those that are a lot more bullish, at 16%, over $1,200, 71% upside. So using the 14%, we will show you the margin of safety today, which is still very significant for this very wide moat company. At 30%, still looking at a buy. 35%, not quite there yet. It would be around $686. So we're saying for the company, 30% MOS, $738 buy price. Now, what we would say is at 35% MOS, a buy at $686, at 40% around $633, and we have seen it at that price not even that long ago, and we would say right now the company is a buy, but around the 40% margin of safety, we would put this as a very strong must buy in the overall portfolio, but again, will ultimately depend on your overall investment thesis and your overall investment strategy. Now, just to signal how undervalued this company is, we will show you at the 12% growth rate, you are still getting a fairly attractive margin of safety. In fact, 20% a buy at 736, at the moment sitting somewhere between 20 to 25%. So again, it does look attractive even if you are someone who believes the lower rate is more reasonable. And we can go one step further by using the 10% for those that do believe these numbers are still too high. You are still in fact getting a margin of safety sitting somewhere between 10 to 15%. But as always, let us know your thoughts, with Wall Street themselves seeing this at $943, upside of 33%. The next stock we're moving on to is Eli Lilly and Company. Now, before we look at this company, there is also Novo Nordisk, one that we have talked about significantly on this channel, one that we do also like a lot. However, in comparison for Eli Lilly, this company does have more growth, but also does trade at a higher valuation. So whilst we would have included Novo Nordisk in the episode today, this is perhaps maybe for those that already hold NVO and are looking for another one in this sector. Eli Lilly and Company is the one we're looking at, which is down 3% over the last year. Year to date, down 2%. Over the last 10 years, one of the strongest ones that we've covered so far in terms of performance, up 934%, trading near their 52-week low, pullback from just under $1,000 with a double buy from Seeking Alpha as well as Wall Street, and their latest quarter saw some very strong growth, in fact revenue up 45%, with efficiencies to their gross profit margin up 2 percentage points, but we did see the net profit slightly lower, down in fact 4. Now, they are expecting mammoth growth to continue for the company. Just look over the next 4 quarters, very large double digit, in fact Q3 triple digit growth. However, worth pointing out, they have missed 2 of their last 4 quarters, 50% track record including the most recent quarter, and based on 2026 numbers, forward valuation comes all the way down to 25.4. We also want to flag this company's average forward PE over the last 5 years is just under 38. Now it does sit significantly below at 30.4. This again is one typical undervaluation signal, but we should also reflect that the yield of 0.79 is lower than the 5-year of 1.25, and that this model also shows undervaluation as it does in fact sit below the bottom end. Not something that does happen very typically for the company. In fact, more often than not, it trades at a severe overvaluation level. And also worth pointing out that the blue tunnel increasing is always a great sign, pretty much something you want to see with every company you're investing or considering for them to be worth more as time progresses. Now, maybe no surprises, but their valuation grade does come in at an F, something we've noticed for a lot of growth companies. They get very good performances on growth and profitability, but valuation doesn't look as strong. Now, with the F, this is showing us that the sector trades a lot lower. You're paying a 100% premium or thereabouts to that market. However, against their own 5-year average, they are trading 21% lower. and pretty similar, like we have said on other stocks, a fairly consistent theme, massive premium to the overall market, but at a slight discount to their own historicals. Now, institutions love this company. In fact, ownership of around 83%. They sold 40 billion over the last year. They bought nearly twice as much, but just look at the most recent quarter, they added 58 billion worth of shares whilst only selling around 2 billion. And this has been quite a consistent theme for the company. You'd have to go back to Q3, although very minimal in terms of difference. In fact, Q2 2023, where we see a very large opposite signal. And as we said, this is one they are very bullish on, as well as in the most recent period. In fact, the buys have only got bigger and bigger from Q2 of 2024. Growth also looks very impressive at an A+. Year-on-year revenue 36%, forward-looking 28%, well above the sector in the mid to high single digit, but also well above their own 5-year at 13% and 12% respectively. They're growing their revenue at a much faster rate, whilst also anticipated to grow their EPS even faster, 29% over the next 3 to 5 years, above the sector at 10% and above their own historicals of 21%. Same applies for profitability, so they actually get a double A+ score. A+, where we notice on the gross profit margin basis 82%, sector at 60%, their own 5-year lower at 78%, and in terms of the bottom line, 23%, the sector as a whole burning through cash, -2%. Eli Lilly on average over the last 5 at 21%, so we're seeing efficiencies, revenue growing at a faster rate than over the last 5 years. Also, margins looking a lot better, whilst generating a mammoth 9 billion of cash from operations over the last 5 years, lower at 6.5%, but also the sector is just burning through cash, -12 million. And as we have done, we can highlight a quick summary with a double buy from CE Alpha and Wall Street, hold from Quant, F on valuation, A+ on growth, and an A+ on profitability. Now, intrinsic value for the company comes to just under $700, something we haven't seen for the previous companies, where the current trading price does sit higher, so we believe at the moment it is trading at a premium. Now, in terms of our DCF model, we have a growth rate of 35%, and what this is telling us right now, if you believe this is appropriate, which does look fairly high, although as we saw, their growth metrics do look very strong, then right now there is in fact a downside to the company. If you believe 40% to be the right rate, then in fact we can see a $958 price target, 27% upside. And one thing we want to point out, Wall Street see this at $1,000 over the next year. That is upside of 32%. So what this flags to us is that they believe the growth rate will be higher than 40% because they see the intrinsic value above. Now, as we are using the median rate of 35%, we believe this company, even around the intrinsic price, could be one to consider, but we would like at least a 5% margin of safety, so around the $650 mark, around the 52-week lows of Eli Lilly. This could definitely be a strong growth company if you believe in them over the longer term and you do want a big pharma in the portfolio. But again, let us know your thoughts below. We then move back into the semiconductor space with TSM, Taiwan Semiconductor Manufacturing, now up 25% over the last year. Year to date, down 10%. Over the last 10 years, up 626, another outperformer of the S&P, trading bang in the middle of the 52-week range. Very favorable ratings, similar in fact to Uber that we saw at the beginning. Buy from Seeking Alpha, double strong buy from Wall Street and Quant, and another company with very healthy earnings from the quarter just gone by, up 35% year on year, in fact, on their top line, with some very promising efficiencies, gross profit up 6, operating up 6 as well, and their bottom line up 5 percentage points. And we always love to see green right across the board, 100% historical track record, growth anticipated over the next 4 quarters, trading December 2026 numbers at a forward P of 16.4, and we can see that undervaluation signal, forward valuation 18.8, below the 5-year of 22, yet the yield does in fact offered today to investors sit lower at 1.54, given the average is at 1.8, and this valuation model here also shows us, one, that the blue tunnel is increasing, good sign, and that we see disparity between the lower end and the current value. Again, not something we do see that typical, we've only noted it a few times over the last year, so one possible indicator that this could be a company to consider. And on the valuation, a little bit better than the previous companies at a C, and that is, as we can see, them trading at an 8% discount as well as a 16% discount to their own 5-year numbers, and in fact for the large part of both valuation metrics on the sector comparative as well as their own 5-year, TSM is actually trading at a discount, and institutions with their 17% ownership have been selling 17 billion shares over the last year, buying 22 billion as well as buying more in fact in Q1. If you want to see the opposite trend, you'd have to go to Q2 2024, and whilst the difference is fairly similar, if you want to see a larger disproportion, you'd have to go back to pretty much 2022, where every quarter we do get to see institutions very bearish, selling more than buying. Growth looks good though at a B+, revenue year on year 40%, forward looking 28%, with the sector in the mid-single digit and their own 5-year lower at 21 and 17, as well as EPS over the next 3 to 5, 21%, sector at 14, their own 5-year at 19, so company increasing revenue at a faster rate than their own historicals, as well as anticipated faster rate on the EPS. Profitability also comes in at an A+, with gross margin 57%, above both sector at 50 and their own 5-year at 54, and we can see their bottom line, again incredible, 42%, maybe one of the best net income margins you will see on this channel. Sector median sitting at 4, a lot lower, and their own 5-year a little bit below at 40%, increasing revenues faster, earnings per share quicker, as well as in fact more profitable on their margins, and also generating a lot more cash from operations, 61 billion, their own 5-year at 40, and we can see sector a lot lower at 110 million. So for TSM, we can see double strong buy from Wall Street and Quant, buy from Seeking Alpha, C on valuation, B+ on growth, and an A+ on profitability. Now intrinsic value comes to $222, which is the average of these 3 models that you see on screen, and remember you can always grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether for TSM or any others, but given the current price, we are in fact seeing a margin of safety today. But remember, one thing that sticks out with this company, maybe more than the others, is the geopolitical tensions with China, Taiwan, and in fact the US and the tariffs, so you may be looking for a bit more in terms of the MOS. 20% in fact is what you're getting at the current value, with Wall Street themselves seeing this at $242 over the next year, 37% upside. Now we do like this company, but we would say given the tensions you would want a larger MOS, somewhere around 30 to 35%, around the $144 mark could be one to consider adding a very high quality company, or even 30% for those that do believe over the longer term this company will continue to massively outperform. As always though, do give us your thoughts about these companies in the comments below, whether you've been adding to any of these, whether they're on your watch list, or for whatever reason they don't fit your overall portfolio. And don't forget to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in the Patreon where we cover our weekly buys and sells, and as always, have a great day. We'll see you all on the next one.